Hey everyone, Meet Kevin here. If you're thinking about investing in HouseHack, this is my final pitch to you. We are closing our fundraising opportunity for accredited investors on March 31st, 2023. That's called our Reg D filing, which means if you haven't signed your DocuSign at househack.com, the solicitation, prospectus, you might not be able to invest. Now, we do hope that our Reg A will be approved. That would be for non-accredited investors. And we hope that non-accredited investors will be able to invest between May and July. But we're not submitting to the SEC until about the first or second week of April for that Reg A. And we're submitting in such a way where we hope our filing is perfect, and maybe they'll give us the green light to start raising money in as soon as 27 days. But we're being told the average is 3 to 6 months, and in some cases it could take as long as a year to get a Regulation A non-accredited round of filing through the SEC. That's why if you're an accredited investor, it's important to consider investing now as opposed to waiting for the non-accredited round, because if it takes too long, we might have to skip the non-accredited round. Now, we hope we can let everybody in, but we might have to skip it. That does mean March 31st is potentially the last opportunity to invest. Again, the hope is it won't be, but it might be. So let me give you a quick broad overview again of what we're doing at HouseHack, what the goal is and the mission is, and let's take it from there and get into some of the details after that. So remember, our mission is to help people invest in real estate in a way that promotes affordable housing. We do this in a very simple way. We buy properties that people aren't either occupying or able to occupy safely. That is, homes generally typical homeowners don't want to buy anyway. Think moldy homes, fixer-uppers, hoarder houses, otherwise damaged homes where most people would look and say, you know what, that's too much for me to handle. Let someone else restore that home to its former glory. See, that's our goal. We're not going in demolishing properties and gentrifying neighborhoods by putting in McMansions and really expensive homes and trying to flip them for a premium. What we're actually trying to do is just take homes that are unlivable and bring them back to the market so that way we can increase housing supply and actually help with the affordable housing crisis in America. Since we're not tearing down homes and redeveloping them, we're really just bringing regular homes to market and renting them out at a fair market value in a high quality manner that's then a win-win-win for investors in HouseHack, the team at HouseHack, and of course, our tenants. We may even want to add guest units or casitas, known as ADUs or accessory dwelling units, at the back of homes in the future to help increase housing supply and also help increase cash flows. That'll help address America's affordable housing crisis. So that's sort of a broad overview. Then we can get into some more of the weeds, the details, so to speak. So it's important to know that so far between 2022 and where we are in 2023, home prices nationwide are down between 8 to 24%. But there are various different winds blowing in different directions. In some areas, housing is actually trending up, and one of the reasons it's trending up is because of a lack of remote work from employers in the region. Whereas in other areas that are more remote work friendly, we're actually seeing somewhat of a decline in housing prices, potentially as we undo some of that COVID push. So we're keeping all of this in mind along with analyzing what award-winning economists are saying, like Robert Shiller, famous for the Case-Shiller Home Price Index and Princeton economists, who suggest that home prices could end up being much lower in the third and fourth quarter of 2023 as housing inventory climbs. And we completely agree. This could then be a fantastic opportunity to buy real estate, cash. And that's exactly why we want to leverage my expertise and finishing our fundraising round before we get into buy mode. See, that's the beauty. We can use our staff now to help with fundraising, and then when we are completely done with fundraising, we can focus on actually buying and renovating and managing real estate. That way we're not employing two different teams. We're all about efficiency. In fact, we don't use outside funding help for advertising for a fund or funding platforms, which could often take 3 to 7% in fees of funds raised, which would cost us millions of dollars. We're not doing that. We're doing what's, in our opinion, best for investors and being as efficient as possible and as cost conscientious as possible. That's very important because every single property, we want that same principle to hold true. That way we can actually provide quality, affordable housing and a win-win for tenants and investors. So simply put, we're going to buy properties that are fixer-uppers. We're going to fix them up. We'll buy those properties cash and use cash to fix up the properties. Then we'll rent out the properties to tenants that we've screened and we'll go on from there. In the future, we might do some really cool things. And as an investor in HouseHack, you would benefit from that as well. Whether it's us sourcing materials more inexpensively to reduce the cost of our renovations, or it's leveraging our portfolio to make sure that we can expand the use of our capital and increase the returns, the internal rates of returns for our investors. Or maybe in the future, it's creating a no-fee version of Vanguard, but for real estate via creating some kind of platform in the future. Who knows? We have a lot of ideas, but what's most important right now is making sure we can make money where we know already we can build a strong foundation of making money and having cash flow. And that's by buying fixers, fixing them up, buying in great neighborhoods, renting them out, and holding them. Then we can always figure out what's next from there, and we've got endless ideas. So that's why right now we're focused on where are the best areas. And we want a diversified portfolio of homes, maybe even multifamily properties. These might be in diverse areas like Florida, Georgia, Utah, Arizona, Texas, Nevada, Colorado, California, or other states and various different cities within them. We'll be very deal driven. We're not going to turn away an amazing deal in a great area that meets our criteria. If the numbers make sense on an individual deal, we'll strike. And if it doesn't make sense, we won't feel pressured to buy. We're also not going to let any artificial intelligence or software make decisions for us. Those tools are tools that we're developing because we think in the future they'll help us with deal finding. We have a great wedge finder that already exists that the company owns. They'll help us with tenant screening and property management and construction. But for now, a lot of our work is still going to be very human-based as we still go through the trials of growing with AI, just like everybody else is in our society right now. But our formula is super simple. We think my 7-year-old son, Lord and my 7-year-old son can handle the formula. It's buy a $400,000 to $450,000 home in a $600,000 neighborhood and evaluate how much it's going to cost to fix it up and decide whether or not to buy it. If it costs $200,000 to fix it up, we won't buy it because there wouldn't be any equity gain left. If we can buy the home and fix it up for $30,000 to $50,000 and we can gain $100,000 to $150,000 in equity, we'll buy it. It's that simple. That's what I call buying in the wedge. The wedge protects us in case prices continue to fall or if costs come in too high. So, who is this company for? Well, really, the beauty of HouseHack is you potentially have the diversification of real estate without having to do any of the work. And HouseHack is not a real estate fund. It's a real estate company. See, you are buying into the umbrella company. In the future, if we have individual real estate funds or platforms or artificial intelligence software or whatever we have in the future, you would share in that ownership. But right now, you're actually not paying any premium at all for all of the potential ideas that we could have at HouseHack. That's because we are raising money at a 1-to-1 cash valuation. Now, that's generally unheard of in private equity. But the reason I'm doing it is because I'm only advertising this to the followers that I have as either course members or people who follow me on social media like on YouTube or Twitter or otherwise, people that know me. And I became a millionaire through real estate. And I know I can do it over and over again. And I want to do that at scale for my followers. Now, I can't guarantee that, obviously. Any startup is a risky investment, and you should read all of the details in the solicitation at househack.com and understand the risks of making a private equity investment. But keep in mind, I've been in real estate as a realtor, a broker, licensed lender, contractor, and have personally applied this wedge deal formula over the last 13 years in over $20+ million of personal real estate that I have personally owned with my wife, no partners, just us, and done the same thing for over $150 million of client real estate. So we're going to use my formula and we're going to replicate it. And that's why we think investing in HouseHack is a fantastic opportunity, especially since we're raising at that amazing 1-to-1 valuation. Just to be really clear what that means, think about it this way. If you invest $1 million into a company that is worth $100 million, you would get 1% ownership in that company. But if that company is worth $100 million because somebody on paper said it was worth $100 million, and the company really only has $5 million of assets, you've just contributed the equivalent of about 20% of the assets for 1% equity in the company. That's not what we're doing. Even though that's normal and we're not wanting to ever come across as bagging on what's normal, that's totally fine for many companies. What you're really doing is you're paying for the leadership, the vision, the potential, right? What we're doing is we're raising money at net asset value, which means if you put $1 million in and we have $5 million, you're a 20% owner. If we end up raising $50 million and you put $1 million in, well, in that case, you're a 2% owner. But your 2% represents 2% of all of the available cash. We would have $50 million in cash. So again, the valuation of the company is the cash that we raise. If we raise 25, the valuation is 25. If we raise 50, the valuation is 50. So whatever our valuation is, it'll be equal to the amount of cash we raise, plus and minus a few little minor closing fees, which would generally be like attorney fees for closing the round or whatever. That takes a little bit off, but it's super, super nominal. And I'm mostly saying that because it's probably not exactly perfect, and I don't want somebody in the future to be like, it was a little bit off. But that's what we're doing. Relative to other companies, it's a massive difference, and it should be relatively obvious that what we're doing is pretty dang unique. Now, the cool thing about this, and no guarantees as well, because any investment could obviously go to zero, but something else that's really cool about investing at a 1-to-1 valuation company is even a regular real estate fund can tend to trade for 2 times book value. So if you invested at a company at $50 million and it were to trade at 2 times book, it'd be worth $100 million, which means your money would potentially be worth double in that valuation structure. Again, no guarantees. Then, of course, you could look at a different style of company that maybe has artificial intelligence, software, or they've created some kind of platform. Like maybe we can pull off the Vanguard of real estate. And maybe we'd sell for a multiple of 5 or 10 times book, or maybe even not a multiple of book, maybe a multiple of revenue or earnings per share. Who knows? I certainly have no idea, and I can't make any guarantees. All I know is I'm committing my personal net worth to this company. What I've done is I've personally, and my other business, my media business, my YouTube business pays for this. I personally bought a plane to make me the best CEO possible for HouseHack. I am paying for that plane. I pay the gas, the pilots, the insurance, the hangar space, everything, the maintenance, everything related to that plane, I pay. Because that's my personal commitment to make sure that I can be the best CEO possible for HouseHack and make sure that if I need to be somewhere for the diversified real estate portfolio that we want to build, I can be there. And it's not coming out of the HouseHack investor dime. That's because I have such faith in this company that I'm not worried about the near-term reward. I'm looking at what's this company going to look like in 10 years when, knock on wood, we have the opportunity to IPO. That's my hope, that's my dream, and I invite you to join the journey. If you're not an accredited investor, stay tuned, hopefully for between May and July. I'll keep you updated along the way. If you're accredited, check out househack.com to learn more.